webinar series for 2022. I'd like to thank you all for joining us. We have scheduled 5 webinars for the fall, and we'll have informative discussions on a range of topics, including what we're talking about today with the U.S. current ag outlook, and also how to handle human resources, cybersecurity, and other informative topics for you all. The webinars are being recorded, as you just heard, so you can view them later at your convenience. I would also like to invite you to learn more about the Executive Farm Management Program. On the last slide, we'll actually have a QR code, and that code will allow you to link up to the website to show you information about the program, when it occurs, what the costs are, and you can also hear testimonials from past graduates of the program. Any questions you have, you can also refer to me just whenever you'd like to. At this point, I'd like to just introduce today's speakers. We've got Nathan Smith, Dr. Nathan Smith from Clemson University. We've got Scott Mickey from Clemson University, and we've got Dr. Blake Brown from NC State University. And again, they're going to be discussing the U.S. current ag outlook for this fall. So I'll turn it over to Dr. Brown and leave it with him.
All right. Thank you, Michael. I just want to say it's great to have Michael on board. You know, succession planning is a big part of what we do at EFM, and that's important for our program as well as your farms. And so Michael is the new director of the EFM as I retire this fall. So I'm going to look forward to helping him with some of the, well, probably the fun stuff, Michael. I'll leave all the hard stuff to you now. But I look forward to continuing to work with the program, but I'm very, very glad to have Dr. Michael Best as our new director. And hopefully y'all will take some time to get to know him, and we'll keep this program rolling on. We've got over 145 alumni now, which is really good. And I see a bunch of familiar names and faces on there this morning. Well, with that said, let me get started. We're going to move quickly this morning. We've got a lot of ground to cover, so I'm going to share my screen and get the slideshow started. And we're going to talk a little bit about what's going on in ag. And as usual, there's a lot going on. So I'll kick it off and talk about some general themes, in particular cost of production, and mention a couple of our commodities. And then Scott Mickey's going to follow me. He's going to talk about corn and soybean outlook. And then Nathan Smith is going to end it up for us talking about cotton and peanuts. So as we all know, we've got very strong commodity prices, both in the livestock sector and the crop sector. What's unusual about this year, though, is just the cost of production, isn't it? I mean, that's the real story. We dealt with low commodity prices before, but it's not been too many times in history that we've had high commodity prices but had production costs so high that it's really eaten into any potential for profitability. We had a very profitable year in 2021. We had good yields, but 2022 has been much more difficult just because of the cost of production. And when we look at that, you can look at the different components of it, but Farm Bureau estimates that about production expenses increased about 6% this year after a 12% increase last year. So overall, that puts the production cost increase on U.S. farms averaging around 20%, not quite 20%. So those are really big, and we know some items have been gone much higher than that. That's a difficult one to deal with strategy-wise. I know our farmers have tried to implement a number of different strategies where they change their crop mixes, they cut back on crops, trying to minimize inputs this year. But let's talk a little bit about some of these input costs. First of all, I want to talk about some of the ones that are associated with the pandemic. The main one there is transportation. And so if you look at this graph, this is an index of freight container fees on ocean-going carriers. And you can see that that index, which is roughly sort of an average of container fees around the world, went above $10,000 per container back in 2021. We all remember the difficulties that were in shipping, the backups, just the expense of doing it. and just the snarls that that put in their supply chains. Now, thankfully, it has come down dramatically since then, and now I think this was last week, the estimate of this index was $4,800 per container. That sounds a heck of a lot better than over $10,000 per container. However, if you look back, we were down well under $2,000 a container pre-pandemic. So we are still over twice the cost that we had in the pre-pandemic in terms of shipping containers on ocean-going vessels. And the other part of this is that I don't have a slide on trucking today, but if we looked at trucking, it would be very similar. And we know that it continues to be limiting because, in part, just the difficulty of getting drivers for trucks. So while the pandemic-induced supply chain snarls are much better than they were, they're still significant, and they still are adding significant costs to just about everything that we do, whether it's machinery or parts, or whether it's fertilizer or chemical inputs, whatever that is. The pandemic is still not gone away in terms of its impact on prices. Now, I think the good news is that I think it will continue to get better. Just like we see in this graph, shipping costs are coming down. I think we'll see all costs continue to gradually come down. Will they be completely back to normal in 2023? Probably not, but probably somewhat better than they are right now. Well, what I want to do is pick out one of these. It's probably maybe the single biggest category of the production cost increases that we've had in farm inputs, and that's fertilizer prices. The biggest one you see here is anhydrous ammonia. It's those prices have increased to over $1,000 per ton, and this is the Midwest price. You see similar on diammonium phosphate and also on potash, not quite as dramatic as nitrogen, but nitrogen has seen the biggest price increases. And so what we're all wondering is, what's it going to look like for next year? Well, no guarantees. There's been so many factors that have gone into this. All of those supply factors with the pandemic have caused it to be difficult. And then, of course, now we have the Russian war in Ukraine, and that has really put a hurting on natural gas. And we'll talk a little bit more about that one in a minute. Let's just look at where our fertilizer comes from. China is the biggest producer of nitrogen, the biggest producer of phosphate fertilizer. No surprises there. They're also a fairly big producer of potash. And that's just because they have so many people to feed and they have such a large agriculture. When you go down below them, you'll see that India and the United States and Russia are all still significant manufacturers of nitrogen. Also, we get quite a bit of phosphate from those countries, as well as Morocco. And then when we go over to potash, though, it really changes up. Canada supplies over 1/3 of the global potash supply. Russia is a very big supplier, as is Belarus and is China. So we got to keep that in mind when we think about the geopolitical conflicts that we have going on right now, because we're just seeing a lot of movement around because of that. I think this slide is really an interesting one. If you look at some of the major agricultural producers in the world and you say, okay, what share of their fertilizer has to be imported? Look at Brazil. Brazil is our main competitor in the global markets on a lot of fronts, whether it's soybeans, corn, tobacco, cotton. But look, they have to import more than 60% of their fertilizer. And their fertilizer use per acre or hectare is over twice what it is here in the United States. And if you've ever been to Brazil and looked at some of those soils in the Mato Grosso, they look almost like gravel. They're kind of like some of our really sandy soils in terms of leaching and just some of the issues that they have with keeping the fertilizer there. If you look down at the United States, you'll see that we don't import a large share of our fertilizer, somewhere around 15–16% of that's imported. But it's a bit ironic because two things. One, we have to import most of our potash, but we're very fortunate to have that supply just north of us in Canada. So we're in good shape on potash because of that. The one that's a little ironic, though, is that we do import nitrogen. What's ironic about that is we have the cheapest natural gas supply in the world. And of course, natural gas is the main ingredient in terms of manufacturing nitrogen. This is a telling slide. Look at North America. You can see that North America has a slight surplus or positive balance of phosphorus. These are basically how much do you produce, and so it indicates how much you'd have to import in that region if you don't produce enough of it. As I just mentioned, Canada produces over a third of the world's supply of potash, so we're in really good shape in North America on potash. But ironically, nitrogen, that first little sort of not exactly purple bar that we see going down there, in North America, we're actually nitrogen deficient. That's why we import some nitrogen. Then look at Latin America and the Caribbean, which of course this includes Brazil, our big competitor in the global market. They basically see they don't have any kind of surplus of any kind of fertilizer. They have to import just basically all of it. Then you go on over and look at Eastern Europe and Central Asia. They produce a lot of all three types of fertilizer, have a very positive balance on it. And so you can see why this conflict that's going on now in Eastern Europe and in Russia has really dire effects on the fertilizer system. Now, this is a really, really important graph, because for nitrogen fertilizers, 70 to 90% of the variable cost of producing those fertilizers is in terms of natural gas. It is the main input. They use the natural gas to get hydrogen, and they combine that with nitrogen or from the air, and then they're able to fix that through the Haber-Bosch process. But look at what has been going on with natural gas prices in Asia and in Europe. They've just gone out the roof. Stratospheric is the term that you see used by many analysts for this. They have just gone out the roof. Now, the bottom line is the Henry Hub. That's the US price of natural gas. Look how much lower it is than these other markets. Now, that graph is a little bit deceiving because the Henry Hub magnitude of change is dwarfed by the magnitude of change in Asia and Europe. But if we really look down at that and had that just graphed out by itself, we'd see that natural gas prices have basically doubled here in the US. They've gone from a little over $4 per million BTUs to now they're almost $9. So they have it doubled here in the United States, which is very significant, but certainly not to the extent that we see in these other countries. Now, what's ironic here is we have the cheapest natural gas in the world, but we still import some nitrogen. We produce a lot of nitrogen. We're a major producer, but we don't produce quite enough for all our needs. And guess where we've been importing some of that nitrogen from? Europe. Well, what's happened in Europe? They're the ones that have the stratospheric natural gas prices. They were using cheaper Russian gas, natural gas. Now, you know, they're having real issues, and the price of natural gas has gone up 300–400% in some places. And so we've seen not a lot of the nitrogen plants there in Europe shut down. So because we were importing some of that nitrogen from Europe, that's really impacted our prices. And you say, well, do we have the capacity to produce more nitrogen fertilizer like anhydrous ammonia here in the United States? Well, my understanding is it takes about $3 to $5 billion to put one of these plants in place, and it takes 3 to 5 years to bring them online. So yes, we could increase capacity, but it's not a short-term fix. And I would think that given the long-term outlook and the fact that our natural gas is cheaper than the rest of the world, you would see some expansion over the next few years, but unfortunately it can't expand very quickly, and so it won't impact the 2023 supply. Now, I will say one of the reasons that some of these plants in the US say that they are not expanding is because we lack the infrastructure to transport the natural gas, you know, pipeline infrastructure and other, that we're limited on that. That's very unfortunate. A lot of those projects have been sidelined under the current administration. So rather than increasing infrastructure to take advantage of this resource, we've basically been going in the opposite direction in the last couple of years. The other thing I would say is we'll just have to see what happens on this front. But natural gas is really our limiting factor. Oh, it's going to mention liquefied natural gas. We are exporting some of our natural gas as liquefied natural gas, but we're limited in our capacity to do that. And it's quite an expensive process. So in essence, these markets like the North American market has been traditionally disconnected completely from other markets like in Europe and Russia. But liquefied natural gas does provide some connection, but it certainly is not an inexpensive process. So when we think about fertilizer prices going into next year, yes, the war with Ukraine will have a big effect. I'm not as concerned about phosphates and potash. And the reason I say that is because I think what you will see is just sort of a moving around. There are lots of countries like ourselves that are not importing as many products from Russia. We got a ban on some products from Russia. Europe is cutting back on their natural gas usage. But I do think that Russia will continue to supply countries like Brazil. In fact, Brazil is in a trade pact with Russia. It's called BRIC, and it's Brazil, Russia, India, and China. And because of that trade pact, I think that China and Russia will want to make sure that Brazil has enough fertilizer to produce a big crop. Now, without that, Brazil would really be up the creek. But I do think they have a very strong political incentive to make sure that Brazil is able to produce corn and soybeans that they need. They don't want to just be relying on the U.S. So on phosphate and potash, we're just going to kind of see, it's almost like a shell game. We're going to kind of see that just move around. We can get our potash from Canada. We have adequate phosphate reserves here. The main snafus with these are continue to be some of the pandemic supply chain issues like we talked about earlier with transportation. But in terms of the war, I think it's just shifting things around. The big kicker, of course, is nitrogen fertilizers, whether it's urea or anhydrous ammonia, because you can't just shift things around because it's so reliant on natural gas. And you can't just very quickly increase the supply of natural gas, say here in North America, to provide that. So unfortunately, I don't think things will get a lot better on the nitrogen front. If you ask me though, will they get worse? Well, probably not than what they were this year. And on the phosphate and the potash front, I would think there's more likelihood of the price situation getting better than getting worse. And I just say that because, as I mentioned earlier, we're moving things around. There's lots of cost associated with that. We still have supply chain snafus, but all of those things will get better and probably not worse. So that's kind of where we're at on fertilizers. Unfortunately, I don't know that there's a lot of really optimistic news on nitrogen fertilizers, but I think farmers are going to be looking at that very closely. I know it's a real difficult decision time now because normally we buy a lot of our fertilizer in the fall. I don't know whether I'd want to do that or not right now. It's a lot of uncertainty, but like I said, I don't envision things getting worse on that front. Perhaps they'll get better. And here's just an example of what we were talking about with Russia making sure Brazil has fertilizer. In May, we know that Russia, even though they're no longer reporting their export data, we know that they sent a lot of fertilizer to Brazil. So that was very important for them as they plant their spring crop, which has been going in the ground just this past month. And as you see, good news for food, bad news for the war. But I do think we'll continue to see that happen with Brazil in particular. Let me talk a little bit about trade. Now, I want to just go back and look at one slide here real quick, because it was something on this slide that I forgot to point out. If you notice the amount of corn or maize that Ukraine is supplying, they're about 13% of global supply of corn. And I think that's really significant. And I know Scott is going to talk about that outlook in just a little bit, but it has real implications for the global trade in grain, because if we go into 2023 and Ukraine is not able to plant their 2023 crop because of the war, if that's disrupted, that could be very disruptive to global grain markets, and it could send corn prices even higher. And which, if you're a corn producer, that you may benefit from that. What's happened this year, though, with all the grain that's been coming out of Ukraine, if the Ukrainians weren't able to ship it, the Russians were. And so this was a Wall Street Journal headline back in early July. Russia was basically confiscating the grain, and they were shipping it to their allies. No surprises there. And then they came up with an agreement in the latter part of July where they agreed to allow more grain exports from Ukraine to continue. So for this year, that has helped this disruption that we've seen. But again, the big deal next year would be if Ukraine is not able to plant their crop in the spring, it could have a very significant effect on corn and wheat markets in particular. Okay, let's talk about China for a minute, because that's something that has really changed over the last 6 or 7 years. We were extremely optimistic about China early on, but pretty much regardless of which party you talk to, regardless of which analyst you talk to, China has become a political foe in a way, really seen as a security threat. And President Xi has basically taken their government back to a hard turn to the left towards communism, and he has shown that he's willing to make very significant sacrifices in their economy to do that. So we have had very strained relations with China, obviously under the Trump administration, but that also continues under the Biden administration. They have not removed those tariffs that were put in place in the previous administration. And in September, they announced, after people have been waiting for a month or so, that they would probably continue to maintain those tariffs on Chinese products here while they continue to have review. And of course, that means that China has put countervailing tariffs on our products. I don't think this situation is going to be better. We're going to continue to do a lot of trade with China. And if you look at, say, soybeans in particular, we're going to continue to export a lot of soybeans to China as they try to rebuild their swine herd after African swine fever. The problem is this relationship is going to continue to be strained, and because of that, it can make it somewhat volatile. And we've seen that in particular in tobacco markets, which I'll mention in a few minutes. If you look at some other export products, which are really important in the Southeast, in particular in North Carolina, this is pork exports, and you'll see that China became a very large importer of pork despite some very high tariffs that they had placed on U.S. pork, and this was because their swine herd was decimated with African swine fever back in 2019 and 2020. Those exports have tapered off some as they've begun to rebuild their herd, and that's why we've seen the soybean exports go up. But I want you to take note of how much of pork products were exported to Mexico. Prior to African swine fever, Mexico was the largest importer of U.S. pork. And so they are returning to that position. And for a number of products, our neighbors to the south and our neighbor Canada to the north are very important in terms of trade. And so I think we'll go back to seeing maybe we don't need to focus as much on China. Maybe we need to focus on some of these other export markets. Maybe we got a little over optimistic about China, but they will continue to be an important export market. This is poultry, very similar situation, even a little bit more dramatic than China. The Chinese began to import a lot of our poultry in 2020 because they didn't have enough pork. They continue to be a major importer, but look again at Mexico and also Canada. They are huge importers of our poultry, so we need to focus on some of these other markets as we go forward as well. Now, let me switch gears completely and just say a word about sweet potatoes. Sweet potatoes are an important crop, especially in North Carolina, but also in the rest of the Southeast. Sweet potatoes have been a darling crop. You know, it's been great. They've been listed as a superfood. Consumption just continues to go up and up and up, whether it's here or in Europe. A lot of our sweet potato producers cultivated that European market. And so basically, though, what we're seeing is that the Europeans have figured out how to grow sweet potatoes. We knew this was coming. We've been talking about it for years. Well, it's here. And so last year, when we had a very large crop of sweet potatoes here in the U.S., we saw exports fall off in Europe because Spain and other countries like Northern Africa Egypt have figured out how to grow those sweet potatoes, and they just have a real advantage in getting those into the European market. That's probably not going to change. So we're going to have to rethink and have a little bit different strategy on sweet potatoes as well. You know, we should continue to pursue our export markets. I think, you know, some of you sweet potato producers are exporting to Asia now. So there are other export markets you can take advantage of. But again, coming back to some of my comments earlier, we really need to focus on our neighbors to the north and the south because we have the comparative advantage in exporting to them, and consumption continues to grow rapidly here in the United States. So we need to focus on trying to make sure we increase consumption of sweet potatoes even more here. And that way, maybe we can regain some of this market share. It just probably won't be from the Europeans. Tobacco, no surprises here. The exports just keep going down. We had about a 300 million pound crop of tobacco this year, even though contracts were up a little bit. Our crop was down because of some weather related issues. Our crop is mixed and variable. We have some really, really good tobacco in some places and not so much in others. Exports do continue to fall, but I think with China's return last year that we should be able to come back around that 300 million pound mark for flue-cured tobacco here in the Southeast. Unfortunately, that China market is going to continue to be very volatile. And so that introduces an extra degree of uncertainty for our tobacco farmers. Exchange rates, would be remiss not to mention them. They're always a major factor in exports, and the US dollar has strengthened significantly. It's been very strong, record strength against the euro. And so that, of course, is not good for export crops like we have in agriculture. It makes us less competitive in the global market. We'll have to see where that heads. Hopefully, we'll see a little bit better situation on exchange rates as we go into 2023. Just going to say one word about the Farm Bill. Watch the midterm elections. If the Democrats continue to control the House, then the administration will push a Farm Bill that is very focused on climate change and the environment. So it'll look fairly different, maybe dramatically different from previous farm bills. If Republicans take control of the House, then my prediction is you'll see the Farm Bill look a lot like the farm bills we've had in the past. Now, the caveat is that regardless of who controls the House, which is where the Farm Bill starts, it's going to be very contentious because one side really wants to move the Farm Bill towards climate change initiatives and the environment. The other side will not want to do that. They'll want to keep it more like it was in the past. And so it's going to be contentious. Who knows, it could turn into a 2024 farm bill. We've seen farm bills like this a few times before, maybe never quite as contentious as this one, but it makes the process much more difficult and much more difficult to get one passed. So stay tuned, but the politics are key to seeing what comes up with that. All right, I'm going to stop and I'm going to turn it over to Scott Mickey and let him talk about corn and soybean outlook, and then we'll try to take a few questions at the end. So take it away, Scott.
All right, thank you, Blake. You can go ahead and advance to next slide. So what I want to do is just not get into the nitty gritty, but just kind of give you some things to be watching on corn and soybeans to get an idea of how things might change. First thing I want to point out is that we have very tight ending stocks in both corn and soybeans for the 2022 crop. Generally speaking, when they gets below 10%, it's considered that we're getting into our pipeline levels, and both corn and soybean ending stocks compared to the expected use are under 10%. If you look at what's happening to the expected yields over the last couple of months, they've also been dropping. Corn started off with a US expected yield of 177 bushels, and yesterday's report had it at 172.5. That's a big drop when you look at having 89 million acres of corn. Soybeans have also seen a yield drop. At one point they were at 51.9, and yesterday's report estimated at 50.5. So while we have ending stocks to use ratios at tight levels, they could get tighter as we move through harvest. So it's important that we pay attention to what harvest is doing and see where we end up on ending stocks this year. I looked at some other years to kind of get an idea of, well, what does the US do in the year following tight ending stocks? And so the second grouping here looks at 2021 ending stocks to use ratio. And they were very similar to what we have today. Corn was 8.5%, and soybeans were 5.7. The following year in 2021, the US increased its corn acres 2.7 million acres, and soybeans were increased 3.8. So one thing to keep in mind is that when we have these ending stocks, we need more production, and one way to get more production would be to increase the planted acres the following year. If you go back to 2012, that's a long time ago, but we also had ending stocks in both corn and soybeans similar to our current levels. And in that year, the planted acres actually decreased. And corn dropped almost 2 million acres, and soybeans dropped 400,000 acres. Just looking at the ending stocks, I would say that, we're probably going to see a battle for a few more acres in both of those crops, simply from a supply and demand standpoint. Go to the next slide, please. One of the ways that we often look at what crops are likely to be planted is looking at the soybean corn price ratio. And that's just simply dividing the November soybean futures price by the December corn futures price. Okay? And so on March 1st of 2017, the soybean price was 2.57 times the corn price. And the theory is that whenever that ratio is 2.4 or higher, that tends to favor soybean production. And as you can see, in 2017, that ratio was almost 2.6, and soybean acres increased 6 million acres, and corn dropped 4 million acres. So for sure, in that year, it was favoring soybeans to be planted. In 2008, it was a similar ratio, and you see that soybean acreage dropped less than corn acres dropped. So again, I would say that that ratio held true in 2018 as it did in 2017. 2019, I just disregarded it because that was the year the Midwest had significant prevent plant acres. It was 2.4, which meant it was going to be neutral. But because of the vast number of acres that didn't get planted, we're not going to share that information. 2020, we had a similar ratio. And again, of course, we had more acres because so many had been prevent planted in 2019. And that brings us back to 2021. And again, we see a very strong ratio at 2.6, which favors soybeans. And in that year, again, we saw soybean acreage increase 4.2 million acres compared to the previous year, whereas corn only increased 400,000 acres. So if we look at those 5 years, throw out 2 of them because of prevent plant, you can see that generally when that soybeans have been priced at 2.6, we see an increase in their acres. This year, that price ratio on March 1st was 2.36. Normally that would favor corn, which would lead us to think more corn would be planted. But instead, what we saw is that soybean acres increased in 2022 versus the previous year, and corn was down. I think as we look at that, we have to factor in how input prices changed in 2022. And I think the cost of producing corn really impacted the ratio that year. So the corn soybean price ratio didn't work in 22, but I think the input price thing kind of explains why. Which brings us to why we're talking today. In 2023, that soybean to corn price ratio yesterday closed at 2.2. And like last year, that would favor corn acres being up relative to soybean acres. But having said that, again, we're still uncertain about what these input costs are going to be. We both see tight ending stocks for both crops. And so it's going to be interesting to follow this price ratio as we move through the fall and into the winter and kind of see where we settle out as we get closer to that March 1st date. But right now, from this one factor, we would expect corn acres to be up in 2023. Go to the next slide, Blake. So again, I don't want to get into the charts. I don't want to give you a whole lot of things that you won't remember. So I just want to point out some observations that I think you need to keep in mind as you plan your crop rotation for 2023. First, that strength of US dollar certainly influences our exports. Blake mentioned that we have a very strong US dollar right now, and that's going to hamper getting exports to other places. It's also important to look at how the rest of the production in the world is changing. Blake mentioned Ukraine, how be interesting to see how their planning intentions and their ability to produce a crop after having a war in our country this past year. If they can continue to produce, that's going to certainly improve worldwide production and may limit some of our export opportunities. South America, of course, will probably plant more soybeans. That's what they usually do. And so again, that could solve some of the world ending stocks shortfall if they return to having a normal crop. That brings me to the third part. We need better production in the US in 2023. And we get that two ways, either acres or through yield. I ran the numbers and saw that if the US had made their expected corn yield of 177, our ending stocks to use ratio would be 11% instead of 8.3. So we don't necessarily need more acres in 2023 of corn to have an adequate supply, but we have to have normal or expected trend line corn production yields. On soybeans, on the other hand, if we had made the 51.9 expected yield on soybeans in 2022, our ending stocks to use ratio would be 6.5 rather than 4.5. So it would be better, but it would still be tight ending stocks. Again, we can get there with better yields. We don't necessarily need to have more acres. And so I'm going to wrap up at point number 5. The commodity markets don't really care what our cost of production is. They're going to trade based on what people are willing to pay for corn and soybeans, what they can use in their operations. But regardless of what our cost of production is, that will not influence the futures prices. However, you need to know what your cost of production is going to be in 2023 so that you can decide which crops are giving you the best return, what's going to give you the best opportunity. And if enough people think that soybeans offer a better potential than corn, we could see soybean acres go up and corn go down, even though today price ratio says corn acres should be going up. So again, what's really important is that you understand what your cost of production is and know what your marketing opportunities are. So that's kind of a brief overview of corn and soybeans for 2023. And I just point out that I do put out about once a week a commodity marketing newsletter that has more details and more charts. If you'd be interested in that, you can go to that website or just email me and I'll be glad to add you to the list. So with that, I'm going to turn it over to Dr. Nathan Smith for a peanut and cotton outlook.
Sorry, I'm having an issue with the slides. There we go. There we go. Sorry about that, Nathan.
No problem. Thank you, Scott. Appreciate it. It's good to be with y'all this morning. Like Scott said, I'm going to talk briefly about cotton and peanuts. You can go ahead, slide, Blake. Cotton and peanuts, dealing with the same things, and the input prices affected and the market prices affected planted acres. But I'm going to start off with cotton, and I guess this slide kind of is a pretty good summary of where we are with cotton this year in the U.S. If you look at the bottom of the graph there and on the red line, that's the crop condition for cotton in this year. And basically, we've gone from one extreme to the other between 2021 and 2022, coming off a lot of record yields around the cotton belt. But back in the spring, this chart starts at the end of May. It's really driven a lot by Texas, Oklahoma, where extreme drought has hit their crop hard. You can switch to the next slide. So NAS or USDA, the report that came out yesterday, been expecting some adjustments to actual planted acres, because the U.S. cotton acres was pegged earlier at about 12.5 million acres. And yesterday it was revised up to 13.8 million acres. So we added about 1.3 million acres. I'd say added. I think the industry and the market had already factored that in because of the FSA certified acres showing it being higher than what surveys had come out. So, but that's an increase in 23%, and that's a response to the prices of cotton in the winter and spring. While we got a 23% increase in planted acres, harvested acres is now estimated down 23% to a low of 7.9 million acres. And so heavy abandonment, Texas, you can see they planted about 8 million acres. They were up quite a bit from last year. Their harvested acres is right now looking at to be about 30% of what they planted. And so while their yield doesn't look to be down as much as you would think, that's basically the yield off of roughly 30% of their acres. Oklahoma's estimated about 50% abandonment rate. So and we were up across the Southeast in terms of planted acres. You can see Alabama, Georgia, North Carolina, South Carolina, we were all up in planted acres and harvested acres. Not quite record yields, but still good yields from last year. You can go ahead, Blake. So you can see this just kind of shows the picture of the big divergence of planted acres versus harvested acres. Our lowest since 2013 is what we're looking at on harvested acres. Next slide, Blake. And then on cotton yield, yields actually for the U.S., if you can back up one. Still looking at cotton yields, if you wanted to draw out a trend line, we're kind of flattened out in our yields, but with drought in the Southwest and so forth, we're looking at a better overall yield though, but just because of it's on the acres that are really driven more in the Mid-South and the Southeast yields. Next slide. So overall, we're looking at 13.8 million bale crop. That'd be the lowest since 2015. That actually increased from last month from almost 12.6 million bales. And so, that's a pretty significant jump in supply in 1 month. I can't really recall that kind of a jump in my career. Go ahead to the next slide. But look at the last column here. This is the balance sheet for U.S. cotton, all types. Even with that big divergence, the jump in planted acres, but the drop in harvested acres are really going to tighten us in terms of carryover. 2.7 million bales is now looking at estimated to be the ending stocks. Because of the smaller supply, looking at and just overall slowing of the economy, looking at lower domestic meal use. We're also looking at lower exports for the 2022 crop, and just a tighter situation. So kind of similar to what Scott was talking about for corn and soybeans. Next slide. And on the world stage, global production is up. Yesterday they revised, did reduce Pakistan and India with some of the flooding going on there, but it's not as the major cotton areas aren't in the areas where the flooding is. And with the U.S. adjustment and with Australia up, the overall production's up a little bit. So basically projecting the same carryover ending stocks for the 22-23 marketing season, with China ending stocks dropping a little bit from last year. So it's still a relatively tight market when we look at the world situation. Not a lot of change by the end of the year, so we could be looking basically a similar market situation going into 2023. Next slide. So what I mentioned was the market kind of, I think already had all this figured in, particularly on U.S. production. December cotton didn't really respond too much to yesterday's report in terms of a major break or drop down. So it's still around $1.04 for cotton per pound. And we're probably kind of narrowing the trading range to see what the actual size of the crop ends up being for 2022. All right, next slide. So for peanuts, this is peanut acreage going back to 2016, just kind of shows you the trend. But just like cotton, there was some pretty big adjustment. Basically 100,000 acres or so, a little more than 100,000 acres or so decrease, fewer planted acres than what was estimated in August, from 1.54 to 1.46 in terms of million acres of planted peanuts. And that come out of the Southeast, particularly, but also the Southwest, and actually the Virginia Carolinas overall was up. We were actually pretty steady when you look at keeping a rotation on peanuts from the previous year. Next slide. Right now, the peanut crop is kind of in the middle from the last 5 years. It dropped down below 70% good to excellent this week as far as crop conditions. So really with peanuts, we're at a point where it's really going to largely be dependent on harvest weather as to what the yield's going to end up being. Next slide. And right now, because of that drop in acreage or planted acres and harvested acres from yesterday's report, we're looking at a 2.9 million ton crop, which I think, again, like cotton, the industry, I think after the FSA numbers came out in August, mid-August, early August, that that the size crop was not as big as maybe was projected earlier. And as long as we've got a 2-ton crop, or around 4,100 pound crop, we're not going to have any issues with supply for sure with peanuts. We're looking at good yields, except for there, Texas at 2,200 and New Mexico at 3,000. So it's really probably what happens in the southeast is to see what that final number will be on peanuts. Next slide. So this is just a summary chart of the supply and demand or production and use. And if we have that 2.9 million ton crop, that'll be lower than total expected use. We will see what USDA adjusted on the demand side. We don't have those numbers yet, but I expect them to drop it a little bit just because of the decrease in production. But really, our numbers on the use side are going to probably be driven in the future by peanut butter. Peanut butter edibles use of peanut butter is down a little bit from over last year, but it was up quite a bit the previous year. If we do have a recession that's prolonged, I think that'll be actually positive for peanuts, and you'll see domestic use or food use grow over maybe the next year or two. Next slide. So overall use is a little bit down. You can see we used a little over 3 million tons in terms of shelled edible use of peanuts, and candy is well up over last year to date in terms of how far the season went. But we're looking at snacks down some and peanut butter down some. Next slide. So really for the rest of the year, it's really going to be dependent on harvested weather and what maybe Texas, our acres are about the ones that are at the most at risk of maybe not being harvested. Could we end up with a smaller crop? Well, again, I think our yield potential could go up in some areas due to some of the areas catching rains in August, but I really won't know till we get the crop in. But with lower carryover stocks, I think prices are going to remain firm for peanuts and maybe even increase a little bit if the crop does get smaller than it is now. And for 2023, that'll kind of put us in about where we were a year ago going in to crop in terms of whether peanuts needs to compete or bid for acres. I think right now there's not a lot of incentive to bid for acres for peanuts. Cotton, I think, is going to probably want to try to keep their acres for 2023, but we'll just see how harvest goes. And that's pretty much it, I think, for cotton and peanuts, Blake.
All right, thank you, Nathan. Got the last slide up here, which tells you that we are doing a executive farm management program in 2023. We're looking forward to having a great program. We need your help in recruiting a good group of farmers for this program. You can find all the information, the program dates, how to apply, everything at our website, go.ncsu.edu/EFM, or you can scan the QR code and it'll take you right to the 2023 program as well. So with that, Michael, I'll turn it back over to you and see if we have any questions.
Nope, you're muted, Mike.
I think if our audience has any questions now, feel free to ask them. You can put them in the chat box as well. So,
okay, sorry about that. I had myself on mute. Yeah, if there's any questions for our speakers today, let's just go ahead and take those questions.
Hey, so I'll ask a question, Catherine Stowe here. And I don't know who's the best person to answer this, but any three of you, what do you see, or how do you see these new ecosystem marketplaces or climate markets playing into both the profitability equation, but also that supply and demand and planted acres of various crops?
well, Catherine, this is Blake. I'm not an expert on that. So Nathan and Scott, please chime in. But you know, I mean, I think, you know, especially when you look at carbon markets, it's pretty much the Wild West right now, it seems like. I think, again, it will depend a lot on what happens with this farm bill. As I mentioned earlier, if you continue to have a democratically controlled House, then the next farm bill may formalize a lot of these things in terms of payments and incentives within the farm bill itself, because it will be a climate change, environmental focused farm bill. If that doesn't happen, though, and you just see more of a traditional farm bill go forward, if the leadership in the House changes, then I think all bets are off. And I'm not enough of an expert, unfortunately, to know how those private markets will continue to evolve, although I certainly expect them to continue to be important, given the importance that most firms and corporations around the world are giving this as a priority for them.
Yeah, I'll just kind of add, I'm not sure that where the private market is right now, where prices are for carbon credits and offsets, it would change production. But I mean, I just don't think that's going to induce a lot of farmers to change their production practices too much, or impact what they plan, or maybe what their yields are. But it could with new, as the markets mature and maybe programs develop around it from the government. I guess for me, it's the demand side, where you see, particularly from cotton and peanuts and fallen soybeans and others, that, you know, trying to show that they're carbon positive. And is that going to affect the demand side? You know, what the major companies want to make sure that you're certified, have some type of certification as environmentally friendly, or you know, carbon neutral or whatnot. So to me, that's the area that I don't have a good picture of how that will play out. I mean, it could play out, but to me, price will end up driving it. Particularly, it'll all be out the window if we have a major weather event, you know, or world events where we got a food shortage.
Okay, thanks for the question, Lydia. Any other questions? Are there any questions? I can't see the chat box.
And no, I don't see any questions in the chat box right now. So,
Okay. Well, I'd just like to thank everybody for attending, and put a plug in for, we've got another webinar coming up in 16 days, a little over 2 weeks. It's going to be Sharon Justice, and she's going to be discussing the do's and the don'ts of paying bonuses. And so that ought to be very interesting. And it's something that when I was in the private sector that I, you know, gave a lot of thought to as well. And so when to give a bonus and how to reward your employees and keep them happy is what she's going to be discussing. And again, that's going to be at 9 a.m. 2 weeks and 2 days from today, so September 29th. So I think we can just go ahead and call this a seminar, and we'll see you next time. Thank you all.